Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, May 10th, 2023. Hope everybody's having a good day out there. I am Raymond Dahlman, your humble host. Hope everyone, like I said, is having a great day. It is gloomy and overcast here in Colorado, as you can tell by the poor lighting on my face. Usually we have a lot of sun coming in through the windows, and today it is gross, and we're supposed to get wind and rain and all sorts of good stuff. So anyways, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. And please give me some thumbs up, likes, shares, subscribes, follows, all the good stuff there. Kind of a meh day again in the markets. Everyone was waiting to see what the inflation data, told us. Wasn't as bad as what, it could have been. It wasn't great, but, the markets just seem to kind of, other than the NASDAQ, the tech sector, it really took off like a spring, but everything else was, not so good today. So, all right, let's go ahead and jump into the numbers and see how things turned out for the day. Dow Jones was down 0.09%, 30 points, closed at 33,531. The S&P 500 was up 0.46%, closed at 4137. NASDAQ was up 1.04%, closed at 12,306. The VIX was down 4.52%, down to 1691 right now. Canada was down 0.42%. Brazil was was up 0.38%, and Mexico was up 0.18%. Going over to Europe, a ton of red. Germany was down 0.37%. UK was down 0.29%. France was down 0.49%. Netherlands was flat down at down 0.01%. Spain was down 0.17%. Italy down 0.43%. Switzerland down 0.86%, and Portugal down 0.27%. Both Russian exchanges were in the green today. The MOEX was up 0.83%. The RTSI up 3.25%. And the overnights in Asia, more red. The Nikkei in Japan was down 0.41%. Australia was down 0.12%. New Zealand up 0.72%. In China, the Shanghai was down 1.15%. The Shenzhen Component up 0.14%. China A50 down 0.99%. DJ Shanghai down 0.89%. Hang Seng down 0.53%. And the Taiwan weighted down 0.55%. So pretty much a sea of red with a few greens mixed in here and there, but not a great day in the markets. All right, let's go ahead and jump into today's market recap. S&P 500 gives up gains, but tech jumps as easing inflation stokes Fed pause bets. All right, get my notes here. On Wednesday, the S&P 500 gave up its gains, but was kept in check by a climb in big tech stocks, which offset losses. This was prompted by data showing cooling inflation, which led to optimism that the Federal Reserve would pause on rate hikes next month. Again, I know I've been saying this over and over and over again. The hope and praying from these financial journalists that the Fed will stop raising rates. We'll see if they get their wish next month. I don't know, but we shall see. The consumer price index rose 0.4% last month, which was in line with economists' expectations, but a deeper dive into the data showed a slowing in core services inflation, a key metric for the Fed. This has led to growing bets on a Fed pause in June, with the probability increasing to 96% from 79% a day earlier, according to Investing.com's Fed Rate Monitor tool. This caused Treasury yields to fall, helping rate-sensitive sectors, including tech, to gain. Apple, Amazon, Microsoft, and Alphabet all rallied on the news, with Alphabet sentiment also boosted by the unveiling of a new folding smartphone and AI-rich software updates. However, Airbnb dominated investor attention after its shares plunged more than 10% due to downbeat guidance offsetting better than expected first quarter revenue. The company had forecasted that bookings will grow more slowly than revenue in the second quarter of the year, and that the average daily rental rate will be slightly lower than a year earlier. This led Deutsche Bank to state that they expect shares to remain under pressure until there is a clear path to meaningful Knight's reacceleration in the second half of the year and into 2024. Electronic Arts also fell more than 1% despite reporting quarterly revenue that topped estimates as bookings returned to growth on strong demand for its FIFA game franchise. Meanwhile, the energy sector fell more than 1% as oil prices were pressured by a surprise build in weekly U.S. crude stockpiles. Devon Energy Corporation, Schlumberger, and Occidental Petroleum were among the biggest decliners, with the latter also hurt by quarterly results that fell short of Wall Street estimates. Financials continued to be held hostage by the struggling regional banks as PacWest Bancorp, Comerica, and Lincoln National Corporation led losses. Meanwhile, in Washington, lawmakers are set to continue talks on raising the government's $31.4 trillion dollar debt ceiling after discussions a day earlier yielded little progress. I can't imagine talking to Joe Biden could lead any progress. The man is basically a human vegetable. However, hopes of an immediate breakthrough remain slim as Democrats refuse to accept a funding bill that includes spending cuts. Yeah, you're going to have to stop spending so much money. I mean, that could probably solve the debt problem, really, really fast. Instead of spending $5 or $6 trillion, that's not your money. You could cut that in half. Maybe instead of spending $1 trillion on national defense, which is really more like war in other parts of the world, maybe we cut that in half, cut the military in half, bring all the troops back from all the overseas bases, maybe line them across the border. Along the Rio Grande might be a good area. They could take their rifles and shoot the people that are trying to get into the country. But hey, that's just my opinion. All righty. More on inflation. U.S. annual inflation slows to below 5%. Price pressures are still strong. U.S. consumer prices rose 0.4% last month, in line with expectations, with a core measure monitored by the Federal Reserve posted its smallest annual gain since last April. The CPI peaked at 9.1% in June of last year and has since been easing as last year's energy price surge drops out of the equation. However, stubbornly high rents helped keep the annual CPI at 4.9% in the year up to April, above the Fed's 2% target. In the same period, core CPI, which strips out food and energy costs, again, who eats or drives, rose 5.5% after gaining 5.6% in March. The core CPI increase was pushed up by rising used car and truck prices. OER, which measures homeowners' costs, its owner's equivalent rent, which measures homeowners' cost of renting or renting out property, rose 0.5% for a second consecutive month. The CPI data came after U.S. Labor Department last week reported acceleration in wage and job growth and a record low unemployment rate of 3.4% in April. The U.S. Federal Reserve raised its interest rate last week by 25 basis points to 5 to 5.25, a sixth rise in the benchmark rate since March of last year. So some things are getting better, some things not so much. One last article here. It comes from the Mises Institute, written by Frank Shostak. It's titled, Is there an optimum growth rate of money? And, you hear me bitch and moan and complain about how the Fed just prints money out of thin air and creates this, starting to rain, or hail. Hopefully it doesn't beat the crap out of my truck. Printing, they, for some reason, the people at the Fed seem to think you have to grow the money supply by 2% every year to keep things keep things running right. I don't know why. That just makes everything more expensive, means that the cost of living doubles every 35 years, 36 years. So, it's just, to me, it just doesn't make a whole lot of sense. So let me go ahead and we'll dive into this article. According to economist Frank Shostak, the concept of economic growth requires a growing money stock to accommodate the increase in demand for money is incorrect. Shostak argues that money's main purpose is to be a medium of exchange, not to sustain economic activity. He also notes that over time, people have settled on gold as their preferred medium of exchange. However, most economists doubt that gold can serve as money in a modern economy because of its limited supply, which risks destabilizing the economy. Therefore, most economists believe that the government must control the supply of money. Shostak also argues that in a free market, there cannot be too little or too much money. If the market is allowed to clear, no shortage or surplus of money can emerge. Once the market has chosen a particular commodity as money, the stock of this commodity will always be sufficient to secure what money provides. Therefore, in a free market, the idea of optimum growth rate of money is absurd. In the past, paper money was not regarded as money, but as a representation of gold. And actually, paper money is not money, it is currency. Money has tangible value. Paper, none. So, where was I? Let's see. Banks could now be tempted to boost their profits by lending certificates not covered by gold. In a free market economy, a bank that overissues paper certificates will quickly find that the exchange value of its certificates will decline. To protect their purchasing power, holders of overissued certificates would likely attempt to convert them back to gold. However, the government can bypass this free market discipline by decreeing that overissued banks need not redeem paper certificates into gold. kind of what they've done in the last 100 years. This uncontrolled expansion of paper certificates increases the likelihood of setting off price increases that could break down a market economy. To prevent such a breakdown, the supply of paper money must be managed, which can be done by establishing a monopoly central bank that manages the supply of paper money. However, even Milton Friedman's scheme to fix money growth, the money growth rate at a given percentage, will not eliminate the problem, because a fixed percentage of growth is still money growth, which leads to constant generation of money out of nothing, resulting in persistent declines in money's purchasing power, which destabilizes the entire monetary system and gets us back to right where we are today. So, all right. Well, that was just some food for thought. I just thought that would be something good. If the article is in the show notes, so you can go and read the entire thing in its entirety. But that's everything I had for today. I hope everyone has a wonderful evening out there, and we'll talk to you guys next time. Adios.